Welcome to Affordable Finance, the place where financial products and policies are made accessible to all. Today we'll be discovering the tools that the European Central Bank can use to influence the economy. The European Central Bank and the national central banks of the 19 participating member states to the Euro system have one objective, which is to maintain price stability in the Euro area. And that simply means protecting the value of the euro. And in order to do that, the European Central Bank has a variety of tools that they can use. And today we'll be looking at what those tools are. So essentially banks, this is a bank, take in deposits from people that are saving money. And then with that money, they make loans to people that need to borrow money, right? And they make money on the difference between the rates that they charge the people that borrow money from the rates they have to pay to people that deposit money in the bank. And so that creates two types of risks. It creates a risk which is called the interest rate risk, which is essentially the difference between this rate and this rate. You always need to make sure that this is higher than this. And then it creates also another risk which is called the credit risk. And the credit risk is the possibility that someone that borrows money from you does not reimburse the loan. And so in order to protect that, the European Central Bank has what's called minimum reserve requirements. And the reserve requirements are pretty straightforward. So let's say you have 5 deposits of euro in your bank. Then what the central bank does is they come in and they say, well, if you've got 5 deposits, you need to keep a minimum reserve, which is this one, and make sure that this is available at all times. And the other here, all these ones, you can make loans, these loans here, out of it. And so if obviously the central bank increases the minimum reserve requirements, that means you've got less units available for loans. And if it decreases it, then it increases it. And that has an impact on the volume of liquidity in the euro area, which also has an impact on the interest rates that people are going to have to pay in order to borrow money. This is something that's set and is not necessarily changed very often, but it's decided by the European Central Bank. The one that's used almost weekly, it's what's called open market operation. And open market operations is simply the European Central Bank, so I'll draw a little man here, which is going to be the ECB, and another one here, we can make a little lady here, which is the bank. And open market operations is the European Central Bank going on the markets in order to purchase what's most of the time called government securities. So this is a little box, which is a security. And this will come towards the European Central Bank, and in exchange for that, then the European Central Bank will give money to this little lady here running the bank. And this new money is going to generate an influx in liquidity, which is going to enable this bank to make extra loans. And because there's more money available, then the rates should go down, right? And those are called open market operations. And these go both ways. So you can either buy security, like explained here, and this creates extra liquidity, or the European Central Bank, if they feel that there's a risk of too high inflation and they want to reduce the level of liquidity in the market, what they can do is instead of buying, they can sell securities. And then the money is going to go in towards the central bank, and that's going to increase the interest rates. The other role that the European Central Bank plays is what's called the standing facilities. And here it's pretty straightforward. So you have banks, which I've explained, they make deposits, they make loans. And throughout the day, they're going to be, because they're an intermediary, what's going to happen is they're going to transfer. They're going to transfer money to other banks. They're going to transfer to each other, to foreign banks, to large clients, to other counterparties. And at the end of the day, the banks is either going to have a surplus of cash on hand or they're going to have a shortage of cash. And in order to make sure that the next morning everybody's ready for business, what the European Central Bank does is that it says to the banks that have a surplus of cash, they can come to the European Central Bank and deposit that surplus overnight. And the same goes for the banks that have a shortage of cash. They can come and get a quick loan. And so what happens is that it balances things out so that the next morning the banks are able to do business. Sorry, that goes in the other sentence. So the deposit facility for banks that have a surplus, this is a surplus, and then a lending facility for banks that have a shortage. And that's a key role that the European Central Bank provides. It happens every day. It really enables the flow of money between institutions, and it changes. It's pretty straightforward. Then finally, the fourth and sort of last tool, and this is not a usual tool. It's when things are not going super well. And it's when you're faced with a recession or a depression, and that regardless of all those actions that you've taken, still the economy does not kick in and it doesn't restart. And so then the central bank just uses a tool which is more rare, which is called, in Europe they called it the asset purchase program. It's also known as quantitative easing. And quantitative easing is essentially the same thing as open market operation. So you still have the ECB that comes in. But instead of just buying securities, government securities, they will also buy private securities. And in the case of the European Central Bank, as announced earlier this year, they might even buy public securities. And so these are bought by the ECB from financial institutions. And in exchange, obviously, they buy that with money that goes into the banking system. And the objective, of course, is to facilitate the expansion of lending from private banks, and so that you increase the money supply, and you hope that this is going to generate more loans like this. And these are the four tools. Actually, it's 3 tools plus an extra measure here, which the European Central Bank can use to influence the economy.